We're going to be talking about hog market fundamentals, so it's not the funniest topic, so laugh when you can. I don't get a whole lot funnier than that. All right. Thank you to Jill and thank you to Lauren and their team for inviting us here. You know, in my previous roles, I worked a lot with state associations, and I can tell you that Minnesota, you guys are really, really lucky to have the team that you have working for you in the state and at the national level, and I truly mean that. So thank you very much for the invitation. Now, we've been tasked with talking about fundamentals from a corn, soybean meal, as well as a hog perspective. And the reality of the situation is all of us are going to have our own individual bias about where the market is and where it might go. What we try to do at CIH is try to take as much of that emotion out as we can and form an objective opinion about where the market is. So that's kind of the first point is, you know, are margins worth protecting now or not? And then the second point, and really where the art comes in, is how might we want to go about protecting those margins that are projected forward out in time. And that's where I'm going to hand the baton over to Jon and talk about some of those strategies that some of our clients are considering. But first and foremost, I'll get to go through. I'm going to go through some fundamentals here. And first and foremost, we're going to talk about, you know, supply and demand from a hog perspective. And I like doing these overviews because, you know, there's not one data point that we can point to that tells us everything that we need to know. But rather, we're kind of putting together pieces of the puzzle from a supply perspective, from a demand perspective, in order to put that whole puzzle together. So first of all, we'll look at supply. We know that weights have been keeping production in check over the last several weeks. Whether or not that continues, I don't know, but we'll see over time. We know that bellies have been relatively sluggish over the last several months and have been weighing down on the overall cutout value. Whether or not that'll turn around, I don't know. We have high costs of production, and this has been kind of a theme over the last couple of years. Really, this started off with the derecho back in 2010 that reduced the supply of crop here in the U.S., coupled with La Nina in South America, as well as geopolitical unrest over in Eastern Europe, has resulted in a situation where we face pretty high production costs across all of production ag, but in the hog sector in particular. We know that we have crush expansion coming online in the soybean complex that will potentially be beneficial to hog producers down the road. But whether or not that happens immediately, probably it'll take a couple years for that to come to fruition. But it has the potential to dramatically change the way that we think about soybeans. And then finally, we'll look at where profit margins are for the end of the year, and then I'll turn things over to Jon. But first and foremost, the easiest way to think about supply is, or the easiest thing to talk about, first of all, is supply, and we can look at hog slaughter. So here, the way that we read this chart, we can see each line represents a year. You can see 2023 so far here in blue. We can see that so far year to date, pork production, or pork slaughter, hog slaughter is up 2.2%. From that red line, which would represent 2022. So we're up 2.2%. If we look at January hog slaughter, we were up 7% from a year ago. So it's a little heavier than we expected. Part of that was a result of some backing up of hogs that we saw around Christmas time with bad weather across the upper Midwest. So some of those hogs were backed up into January. But we're working our way through those today. If we look at weights, the other component of production, we can see that by and large, hog weights have been below where we were a year ago. A little bit on the lighter side, so it's keeping that overall production in check. This tells us that we're relatively current from a marketing perspective. What the impact of a blizzard across the upper Midwest like this week has on this, we'll see. But they're starting to climb up a little bit, but you know, kind of closer to where we've been over the last couple of years. Now, as we put that all together, we can see total pork production on a weekly basis is up about 2.2%. 1.8% year to date, here in blue again. So again, higher than red, which would be 2022, below where we were in 2021. Now, USDA WASDE report has us pegged at 1.6% year-over-year increase. So we're a little bit ahead of where we would expect to be based on where the WASDE has us at. So pretty good production so far. We'll see what the impact of storms have on the overall situation. Now, this is kind of old news. We already know what happened in the December hogs and pigs report. It's inventory as of December 1st. I basically put this in here because I like looking at maps, and I think it's somewhat interesting. If we think back to when we got this around Christmas time, there wasn't a whole lot of surprises when it came to the December hogs and pigs report. Over here, you can see market hog inventory on a state-by-state basis. Up here on the top left would be breeding hog inventory on a state-by-state basis. So overall market hog inventory was at 98% of a year ago. so 2% lower. It was slightly smaller than the expectations. If we looked at breeding herd inventory, it was 100.5% of a year ago, so up slightly from a year ago. It was a little bit larger than what analysts were expecting before the report came out. So nothing major, but somewhat interesting. Now, overall hog inventory on December 1st was the smallest that it had been since 2016. Okay, smallest that it had been since 2016. If we look at Minnesota in particular here in the breeding hog inventory, we're down 11% from the previous year. So this data goes back to 1963, I believe. And this breeding herd inventory in the state of Minnesota was the second smallest in the history of that data. So the smallest outside of 1975 at just under 500,000 head. So what does that mean for prices? If we look up here and look at the national negotiated net hog price, again, 2022 would be here in red. You can see where we scored those highs in the summer like we typically do. Here in blue is where we've been so far in 2023. Kind of stagnant, not a whole lot moving so far. A little bit of a pop, I think, yesterday in the markets, or so far this week anyway. So hopefully we'll continue to see that move march higher. But you can see overall hog prices are down about 15% from where we were a year ago, which somewhat makes sense when we've been slaughtering more pigs. Now, what does that imply from a futures perspective? The way that we read this chart, there's a lot of lines on here. That's relatively straightforward, I think, anyway. We can see a 10-year average of the cash, or of the lean hog index here in light blue down at the bottom. We can see where we were on the cash, or the CME index last year in the lime green. Now, this black is where we are so far this year. And these blue hashes would be where the futures price indicates for 2023. So you can see that market is pricing in the seasonal high in the summer when we typically see a smaller slaughter, better demand. And you can see over here on the right, the current futures prices was taken yesterday are indicating prices that are at or above where we were a year ago when we get to October and December. The red hashes indicate where we would be for 2024 based on yesterday's close for futures. So again, we expect to see kind of a ramp up in prices into the summer like we typically do. Now, what does that mean from a cutout perspective? So the cutout, if we remember, is going to be an estimate of a standardized pork carcass, I believe 215 pounds, 55 to 56% lean, based upon, first of all, the cuts of meat that then get added up into primals, and then those get weighted average into an overall cutout. And you can see the way that we read this chart, this is a ranges chart. This is looking over the last decade. So you can see a 10-year high in this dotted green line along the top, a 10-year low in the dotted red. On average, this is where we would be over the last decade in the gray line in the middle. You can see where we were in 2022 in red and 2023 so far in blue. So why am I going through this? Well, you can see since last August, we've kind of been in a decline in the pork carcass cutout. It started to ramp back up a little bit here recently, but still some room to go here. We're down about 21% from a year ago. Now, this is a weighted average of the various primals that go into the overall cutout calculation. Now, not every single one of these primals has been impacted the same way. And so overall, since August, the comprehensive cutout, since the beginning of August, has fallen by about $47. Okay, so over here on the left, we can see the different primals that go into that cutout calculation. So the largest component by volume would be the loin, followed by the ham, followed by the belly, etc. Now over here on the right, we can see how each one of those primals has contributed to that fall of $47 per hundredweight in the cutout. So the largest fall, or the largest culprit here, would be the belly. That's accounted for accounted for $19 of that $47 fall. Okay. Now, bellies have been holding the entire complex back a bit. Kind of looking forward, I think this is one thing that gives me a little bit of pause, is everyone seems to be expecting some sort of economic downturn or slowdown in economic growth. What typically happens when we see a reduction in GDP is people tend to eat out less. The belly has really benefited from food service demand. You get bacon put on every single burger, you get bacon put on pizza, you have bacon and ice cream. If people continue to reduce how much they go out, reduce their expenditures in restaurants, that's potentially a headwind for this belly that's already been beaten up over the last couple months. So something to keep in mind there. Now, if we look at cold storage, so this would be an estimate of the amount of product in freezers, commercial warehouses, on a monthly basis. The most recent data that we have is from as of December 31st. And you can see that pork in cold storage started to climb a little bit toward the end of the year. It was up 16% from the previous year. So stocks are building when we look at pork. Same is true for beef as well. Stocks are building, up 7% from the previous year. Now, bellies were up 66% from the previous year. So it's not particularly surprising that bellies have been kind of lagging from a price perspective when we've been building inventories back to where we were pre-pandemic levels. But it's something to keep in mind. Poultry supplies in cold storage on December 31st were 23% higher year over year. That's something to keep in mind as well as we look at potentially an economic downturn. Consumers would be looking to, still consume protein, but probably look for lower cost protein. That's when chicken comes into play. So something to keep in mind. Now, if we look at what that means from a retail perspective, we're currently in month 22 of transitory inflation. Okay, that was good. Needed a pause for that one. So it's month 20 to 22 of transitory inflation. Here we can see different product prices, retail prices. This is as of January, I believe, the date is. You can see bacon prices in blue. Those have come down a bit, but still pretty darn elevated, right? Bacon was at the lowest price actually in January that it had been since June of 2021. So pretty big pullback there, but historically still expensive. You can see chops and hams as well continue to kind of be at elevated levels. They're bouncing around, but kind of tough there. If we look at the overall pork complex, we can see that here comparing the different protein complexes. So you can see pork in blue. You can see broilers or chickens in orange. Green and yellow up at the top would be beef. And then I've added eggs in the last couple months because that's been a pretty interesting story. And actually, I could probably combine the two axes now because eggs have been on a tear. But what we see here is that, the entire pork complex fell in January. It was the lowest level that we'd seen since February of 2022. So that's positive from a demand standpoint domestically. Broiler prices, were higher from a year ago, but they fell from the previous month. Egg prices were up only 150% from the previous year. Although we've seen that start to fall over the last couple weeks, I'd expect that to start to moderate. But what's important here in my perspective is what is pork as a share of beef? How does pork compare to beef in the meat case? And what we saw was as a share of beef, pork prices fell, and they're actually below where we've been historically over the last decade. So that's positive from a demand perspective as we're looking at what is pork competing with in the meat case. It's relatively more competitive against beef prices. So that's kind of from a domestic standpoint. We can't talk about pork without talking about the export situation. When we export 25 to 30% of annual production every single year, we have to talk about exports. So here we can see 2022 exports. That's December 2022 is the last month for which we have official data. We can see that exports, were lagging a year ago for the majority of the year until December, where we were counter-seasonally strong. But overall, exports were down about 10% from the previous year. Now, we had a really strong U.S. dollar throughout most of the year, so that provided a headwind, which made U.S. products more expensive for foreign consumers. But this wasn't consistent across all of our major export channels. So if we look overall, so again, exports were down 10% to the globe from the U.S. But they're actually up year over year to Mexico. This is on a volume basis, not a percentage basis. So to Mexico, we were up 14% from the previous year. And to South Korea, we were up 5% from the previous year. So thank goodness that we had Mexico and South Korea taking our product, because otherwise the major markets were kind of in the dumps. If we look at China over here on the right, that constituted the majority of the year-over-year decrease that we saw. Exports to China were down, I believe, 47% from the previous year. So that was definitely a drag on overall exports. Yeah, I think a couple different. The question was that COVID related, and I'm repeating that because we're recording it. Part of that was COVID related, so they were still under restrictions and really had been up until the last couple weeks. They're also in the process of rebuilding their herd after ASF, which is still an ongoing process. But if we look at, and this is kind of a good segue, so I appreciate it. If we look at overall Chinese pork imports, overall their entire imports shrunk. So the entire pie shrunk, and the U.S. occupied a smaller sliver of that pie over time. So if we look here, this is on a month-by-month basis. This starts in January 2022 and goes through December 2022. This is from Chinese customs data, so probably have to say we have to take that with a little bit of a grain of salt, but by and large, it matches up with most other customs data. But what we see here is here's the U.S. in lime green. So you can see we're occupying about the 5th largest market share by the end of the year. But back in the second quarter of 2020, the U.S. was actually the largest pork exporter to China. So we were number 1 on this chart. The overall pie was about double this size back in March of 2021. So the entire pie is shrunk by about half, and the U.S. is now occupying not the largest share, but about the 5th largest share. So kind of a twofold there. But this is something that we kind of pay attention to over time, and also it kind of shows us changes in position in terms of largest market shares as well. But that's a good question. Now, if we look at where the U.S. is from a price perspective, especially in China, we're looking at competitors mostly from the EU. So this was taken yesterday from Pig 3.3. You can see German prices are here in kind of that orange or red. You can see Spain prices and Spanish prices in yellow, and the U.S. in blue. So you can see both Spain and German hog prices have been kind of on a tear in the last couple days, making U.S. product relatively more competitive in major importing areas, particularly China. Now, I know a lot of folks are pretty bulled up about the idea of reduced production in the EU, and that's reflected right here, right? Less pigs means higher prices. One thing that I think is important for us to keep in mind is that this is a global market, right? And if we look overall at global pork production, this is from USDA earlier this month, they're looking at global pork production increasing by 311,000 metric tons. 311,000 metric tons on a carcass weight equivalent from the previous year. So yes, the EU is going to decrease production. That's the expectation from USDA. But look at this. I mean, Mexico is increasing, Brazil's increasing, the U.S. is looking at increasing production as well. So, I mean, Brazil on its own is almost making up for the reduced production in the EU year over year. That's something to keep in mind. Just because the EU is looking to reduce production doesn't necessarily mean that the world is as well. We can do the same sort of analysis on exports as well. It's a little different story there. So yes, the EU is expected to export less product to the world. That's true. I think everyone would agree with that. But overall trade to the world is expected to be reduced as well, right? So China's expected to decrease imports. Overall exports, the overall pie is shrinking here as well. At least that's the expectation from USDA, and USDA is always correct in their forecast, so we can take that to the bank. That was also a joke. Yeah, I think USDA does a really, really good job. It's really, really helpful. Of course, they're not 100% accurate. But if you've ever tried to find production or export data for any other country, I think you'd quickly realize how fortunate we are to have USDA here in the U.S. doing what they do. Now, here we can look at export commitments so far for this calendar year. This is a ranges chart again. We had a pretty good week last week of export sales. So if we talk about total commitments, we're talking about sales that are on the books and shipments that have already left our ports. So the two of them combined make up the commitments. You can see we're pretty close to where we were a year ago, a little below the 10-year average or 5-year average, but pretty close to where we were a year ago. So overall, I think this chart kind of sums up why economists, they always say economists have two hands because you can always be right. So on the one hand, we have a bullish argument. On the other hand, we have a bearish. We do face headwinds in this market. That's true. We have labor constraints that we've faced for a decade. I don't see a split Congress in Washington, D.C. fixing this anytime soon, whether we're talking about work on the farm or work in the packing plants. I think this one's around for a while. Prop 12, we might get some news here in the next couple of weeks, is my understanding. Regardless of what that happens, I don't expect those sorts of initiatives or the freedom to operate to go away anytime soon. I'll probably just show up in a different mask or different clothing. There's always disease risk and there's competing protein risk out there, particularly from poultry. If we're entering a situation where we have an economic downturn and people are looking for cheaper proteins, I don't think that pork and chickens are necessarily interchangeable, but other people do, right? One has flavor and one doesn't, but other people might not agree with that. Pork's the one with flavor, just to be clear there. From a supportive standpoint, right, there's a number of different reasons, and there's reason to be optimistic, for sure. I don't want to throw water on anything, but it's great to be optimistic. I think it's an important virtue, but it's not necessarily a great marketing plan all the time. But there are reasons to be optimistic, right? We have robust demand. We've had it domestically. There's robust demand from an international perspective, and we've seen that in the last couple weeks. Domestic production has basically remained in check over the last couple of years. We don't have unfettered expansion occurring in the market. So that's relatively supportive. And yes, the drop in European production is supportive of our market. I just don't know whether or not we go to the moon from here or not because of that. But those are some of the things to keep in mind. Now, I also need to talk a little bit about the crop side of things. So basically, when we grow corn in the U.S., it's either going to be exported, it's going to be fed to animals, or it's going to go into ethanol. Now, one way that we try to keep track of this in our office, and we just built this, is trying to keep track of how far ahead or behind are we of where we would expect to be from an ethanol use perspective, or corn use perspective for ethanol. The way that we read this chart is this is weekly corn used, or our estimate of it, weekly corn used for ethanol production in blue. Now, the gray shaded area in the background would be based off of USDA's annual estimate for corn use for ethanol. Where would we expect corn use to be throughout the year? And then this green line is how far ahead or behind are we of where we would expect that pace to be. And so you can see, according to our estimates, we're about 100 million bushels behind where we would expect to be from a corn use for ethanol perspective as of right now. We saw USDA slightly reduce corn use for ethanol in the last WASDE earlier this month. This is telling us that we'd expect to see them reduce that again going forward. Now, if we look at a stock-to-use ratio from major exporters around the world, so major corn exporters, according to USDA, would be Argentina, Brazil, Russia, South Africa, Ukraine, and the U.S. We can see that from a historical perspective, this is stock-to-use, so how much product is left over compared to how much did we use. From a historical perspective, we're pretty darn low, right? It's not an all-time low. This goes back to 1960. It was growing slightly from a year ago, but pretty darn low. Right, so a relatively tight supply situation from a global perspective when we're looking at corn. Shouldn't come as a surprise to anyone. We all know this. We're all living it. But something to keep in mind here. And this is with the expectation of product flowing out of the Eastern European crisis zone right now. Right? The minute that the Black Sea Initiative runs into another hiccup, this could potentially fall even farther. I don't expect, this is going to be a hot take, I don't expect the Russia-Ukraine situation to be solved in the next week or two, right? I think it's around for a little while here. So I think this is going to be a risk in the background and probably a slide that we'll be including for quite a while. As a hot take. You can take that one to the bank. All right, if we're talking about soybeans, we talked about this a little bit at the beginning, but there's extreme incentive to be crushing soybeans right now. If we look at board crush margins that's being offered, so we look at the value of the soybean, we look at the value of the soybean oil and the soybean meal that you can extract from that, board crush margins are at or near all-time highs going out through next January. So this is looking in particular at July. So again, a 10-year range, we can see where we are right now. And this is for July. We're at the 99.8th percentile. So 99.8% of the time over the last decade, crush margins for July have been below where they are right now. if this is the case, what are crushers going to do? Give me all your beans, right? Give me all the beans that you can give me, and they're going to expand. And we're seeing that throughout the country right now. Now, there's crush expansion occurring on an unprecedented pace. Depending on what article you read or who you talk to, it's somewhere between 500 and 700 million bushels of new demand that's going to be expected to come online by 2026. All right. Now, this is beneficial for livestock feeders who are needing to purchase soybean meal and feed it to their animals. A lot of these plants are going to be coming on, or theoretically coming on, end of the year, throughout 2024, throughout 2025. And this is a moving target, right? Because some of these are in the works, some of them are already being built, some of them are already built. But this is going to be create a situation where there's going to be serious competition between corn and soybeans for acreage. Yes.
So what's that new demand? Where's it going to be used? Why 600 million more bushel?
Yeah, the question was, what is that new demand as a result of? And it's primarily a result of renewable diesel and safe aviation fuel. There's been a number of different incentives that have been passed through Congress, included, I believe, also in the so-called Inflation Reduction Act, that provided incentives for these crushers to continue to create these fuels from soybeans. Yeah. A lot of people are likening it. I'm not saying that it's the exact same, but a lot of people are likening it to what we saw in ethanol in 2005 to 8. Right? We're kind of on the precipice, it feels, with beans today. We can do the same sort of analysis if we look at major soybean exporters stock to use. In this case, it would be Argentina, Brazil, Paraguay, Uruguay, and the U.S. would be included in here. A little different story from a stock to use standpoint. So not at all-time lows, but relatively low, especially if we look over the last decade or so. So it's a whole lot of information. All right, so we all kind of have our bias of where things might be going. What we try to do is say, okay, are margins good or bad? Right? That's the first question. So I've told you all this information. Are margins good or bad? And that's a subjective question. But what we can do is we can start to look at how common or rare of an opportunity is the market offering us today. So what I've got on the screen here is looking at fourth quarter margins for 2023 for a demonstration operation that we have set up, I believe, in Iowa. What we can see here is each one of these columns represents one component of that crush. So you can see corn prices, meal prices, lean hogs. But what I want us to focus on is over here in the top right, where I just circled. You can see the open market margin. So this is saying if you had no protection on, this is what the market would be offering you today, or actually as of yesterday, market close, for fourth quarter hogs. And what you can see is the current price is offering a margin of positive $1.94 a hundredweight. Now below that, we can see that the percentile is the 80th percentile. So is making $1.94 in the fourth quarter a good thing or a bad thing? It's a generally good thing, right? If we look at the 50th percentile, that would be our average. On average in the fourth quarter, this farm would be looking at a loss of about, what is that, $4? Is that $4? I can't read that far over there. So is making $1.98 good? Yeah, I would argue yes. Now the next component of the question is how might we want to go about protecting this positive margin that's better than 80% of the time that we've seen over the last decade, and that's where Jon is going to come in talking about different strategies that have different opportunity to better margins, different protection to lower margins, and kind of the trade-offs between those. So for that, I'd like to bring up Jon.
Well, thanks, Dustin. Appreciate it. I think it's always good. I feel like we're in the trench a big part of the day or the week or whatever. It's always good to get that 30,000-foot overview. So appreciate it. And pretty sure if you guys had to listen to me drone on for the past half an hour or whatever, I would have cleared out a significant portion of the room here. So appreciate it. So like Dustin mentioned, I was just going to real quick, a couple minutes, kind of run over a strategy that you could consider if you were excited or attracted to protecting that historically strong fourth quarter margin. And The graph up here it's a little bit messy, but I would just say concentrate on that horizontal 85-45 line there. And what all the other multicolored lines are the past 10 years of December hog futures price. So it's pretty messy. I just wanted to show you visually, hey, 85-45 where we were at yesterday is a pretty decent December price from a historical perspective. Statistically, I think that's like the 72nd percentile of the past year. Anything further back than that, though, it's the 90th percentile of the past 3 or the 94th percentile of the past 5 years. I don't mean to make it sound like it's wildly profitable or anything like that. I mean, unfortunately, sometimes fourth quarter is not, but it is a really good level from a historical perspective. Also wanted to add a little bit of a timing component. So you can see today, so we've got an annual seasonal graph here. Today is in the vertical dashed line there. And then the next couple months are really, from a historical perspective, a good opportunity to protect December futures prices from a historical perspective. So I think that first peak here is somewhere around March 20th or so. And then, that's about June 1st, just roughly, So next couple months here is important from a timing perspective. So we've got, pretty good historically margin opportunities, strong hog prices, and timing is kind of getting in that window. So the strategy I was going to run over just briefly or throw out, I guess, was putting a floor in. And then if a producer was comfortable doing so, potentially selling a cap to reduce the cost of that protection. So I've got that same sort of messy graph up here with the past 10 years of, historical December futures prices. And here the horizontal line is at $84, so if you bought an $84 put yesterday, that would be an unlimited floor at 84. So kind of chop off everything below that, but allow unlimited upside as well. The problem was it's a little bit expensive for sure. So it's $5.62 or something like that per hundredweight yesterday, which, obviously with the margin value we just talked about and costs and stuff like that, I mean, that's a pretty expensive upfront strategy. I will say, just keep in mind that doesn't go to zero the next day, right? So it's maybe not a bad idea to just kind of have a floor in here, see how this thing plays out for the next 1 to 2 months, and then look at reducing the cost. But if a producer wanted something a little bit cheaper up front, I threw on there maybe selling a $94 call, which would represent a cap. So then you'd have sort of a window of opportunity there from 84 up to 94 that you could benefit if we're fortunate enough to see some of those higher values. And that would actually reduce the net cost from $562 a hundredweight down to about $285 a hundredweight. So a lot more palatable from a cost per hundredweight perspective. One thing I wanted to point out, there's a tendency to kind of look for the cheapest upfront protection, which I get, but I would really discourage producers from trying to cheapen that up by selling a put, somewhere below that 84 put. Just if you look visually, all that historical real estate there below the $84 line, I don't really want my coverage to end, anywhere. Even like a $68 put would only bring in like $1.20 or something like that. So I'd really encourage, unlimited downside protection. And then we'll touch on an idea here in a little bit that would, reduce the cost if a producer wants to do so. Then I wanted to introduce, so the little bit of a twist on the strategy would be potentially using LRP instead of the put, which, like I mentioned, would reduce the cost a little bit, which gets all the headlines. But I really think the best part about LRP is how you can address basis risk. So if we think about futures at the end of the year, you've got December futures, which expire on December 15th. And then February futures are sort of trying to estimate where they think the lean hog index is going to be on February 15th. So you've got, 2 months between there where historically, it was the best tool for addressing the price risk. But, it still kind of fell short of where everybody would have liked it to perform. So this is a graph of basis over the past 10 years. And it's the lean hog index versus futures. I threw a line across at even there, so anything below that would be negative basis. And the arrow there in the lower right is just kind of pointing out that end of the year time frame can be the worst basis time frame of the year. And catalyst is, we're typically using February futures or options to address that risk. Well, they don't expire for 6 or 7 weeks down the road, so they can be kind of off on a tangent a little bit relative to where the cash market is at that point in time. You can address that with LRP actually. So this is just a snapshot of where LRP came out yesterday for December. The 43-week endorsement, the end date was 12/19. And just to take a step back, LRP is livestock risk protection. So it's not a put, but it performs very similarly. So you can buy a floor in this case at 84.04, and it would cost $4.64 to buy that 84.04 floor, which expires on 12/19. The attractive part about LRP is that when the policy ends, your indemnity is being determined by where cash is that day, so where the lean hog index is that day, rather than where February futures think it's going to be, 6 or 8 weeks down the road. So over the next week, that end date will drift forward by, a day each day. So like tonight when prices come out, that'll probably be December 20th. So when we get to next week, that end date will be, right at the end of the year time frame that I highlighted from a basis perspective. So LRP by itself would cheapen up that protection. So yesterday it would have cost about $1.86 a hundredweight for this 84.04 LRP with a 94 call, so about $1 a hundredweight cheaper than if you just bought the put and sold the call. But in addition to that, and really my favorite aspect of LRP is if we watch those end dates, we can get those end dates to an attractive time frame to help address some of that basis risk that we've had to bear in the past. So a little bit cheaper cost. Still unlimited downside protection. So rather than selling a put below a strategy, you could, maybe do LRP instead of a put and still have that unlimited floor, and then also address that basis risk at the same time. So quick summary, you still got unlimited downside protection, which is important, I think, for December, that end of the year time frame. And I really think, especially in context with how high cost of production is, you've got, good upside opportunity. I didn't mention this on the graph, but 2014 was the only year that December traded above 94. So where you're selling that cap is very, very high from a historical perspective. And even in 2014, it was down below that during the delivery window, so October 15th to December 15th. So it's not been that high at expiration. So, really good upside opportunity. And then if a producer wants to, they could, reduce the cost of that position and address basis risk by using LRP, potentially. That was it. Any questions out there in general, or?
John, we see the crush and that model. What are you seeing, just to me, a kind of a warning flag is, what are you seeing on non-feed big costs, just for the group to kind of understand why there might be a lot of less interest in building barns and different things that are shoulder pay based off what?
Yeah. So, for the recording purposes, the question was, what are you seeing on pig costs or cost of production out there in general? And, I would say on the, overall cost of production that we're seeing, anywhere in the, low 90s, mid 90s, would catch a lot of it right now. Certainly some of the stuff that Dustin mentioned on the corn side of the equation, especially if we could get, costs down by, $1 or $1.50 a bushel even, which is a big number, but that's really regressing towards historical normal prices in general. We might be able to see those costs get back down into like the mid 80s per hundredweight or something like that. So really very high from a historical perspective. I'm certainly concerned about, the stickiness of some components, right? Obviously corn is going to move up and down, but a lot of the other, costs aren't probably going to be. as responsive to market movements as that. And yeah, I think, from an expansion perspective here in the U.S., there's just a lot of headwinds out there for sure. Everybody's aware of like labor constraints and stuff like that, but then, building costs are still super high and, interest rates being higher and stuff like that. It just seems like it should be under control as far as expansion in the U.S. here anyway. So, yep. Another question?
Yep, you mentioned the fourth quarter crush, which I agree with. Are you doing anything after last year? A lot of producers got burned on corn basis. Anything there on protection?
Yeah. So the question was, is there anything on the corn basis side of the equation from a protection perspective that we can do? And I'll tell you just flat out, that's a little bit of a tough one. Certainly if they're able to go to their feed mill and protect corn at decent basis levels, well, great, by all means, go ahead and do so. What we use to address basis risk on the corn side of the equation would be spreads or calendar spread options. So if you think about, kind of what caused basis, obviously a lack of supply, increases demand there. But if you think about the backside of the futures curve, so after July goes off the board, you've got July and then September and December. And usually July is at especially when there's, major production issues, July can be at a really significant premium to September and then December. And if you go to a producer, a crop farmer, and say, hey, I gave you $11 for your corn yesterday, and futures now, those went off the board, so December's $1 lower or whatever that number is, so I want to give you $7 today. They're going to say, no dice. $8 yesterday, I'll take $8 today as well. So to some extent, that futures curve being inverted like that causes basis issues. And, so you can use a spread to protect from that, inversion causing additional basis issues. So it's a tough topic, I would say. It's caused a lot of problems, especially in areas of the country that were hit by drought this past year. So first best would be, if you have the opportunity to book physical corn at decent basis levels, maybe attack it that way. But if not, there are a couple other tools that you can use to address the risk for sure. Any more questions? Yeah, one more.
Total corn, total crop acres in the U.S. continue to be a number that's being discussed on what actual, acres are going to be planted. And there's a lot of speculation. Where do you see that number happening with high commodity prices across the board? Are we going to find more acres, or is that completely lost to development and other things?
So the question was, as far as like total corn and total soybean acres, where are we going to pick up additional acres there? First and foremost on the corn side of the equation, I forget the exact ratio, but if you look at the ratio of planted to harvested acres this past year, it was really low from a historical perspective. So only 2012 would have been lower. And, a lot of that was because of abandonment, obviously, in the plains areas in general. So number one, picking up some acres if we have a less droughty year, could look like, just that ratio of planted to harvested acres is better from a historical perspective. And then, I think the market's thinking a little bit about, these other commodities out there. Where can we grab some acres in general? Cotton is not very profitable right now, so some of the crop producers that our crop team works with are going to be shifting acres from cotton into other commodities. But even there, the limiting factor is those cotton acres are generally not, top performing acres. They're generally in droughty areas too. So do we want to put in a fairly moisture intensive crop when we're dealing with the drought situation? So I would say those are kind of the two avenues where hopefully we pick up some additional production would be just a better planted to harvested ratio this year. And then, maybe shifting some acres towards principal crops from, like cotton and stuff like that in general.